Hello and welcome to this SWAM MOOC course on Indian economy. And today I am going to discuss about the module titled Indian Money Market, Price Trends and Inflation. Now, after completion of this module, the students will have a thorough idea about first, the concept, functions, important features, the important instruments, as well as the recent measures in the reform measures in the money market. Second, they will also understand the price trend and inflation in Indian economy since the inception of economic planning and how this inflationary problem has been contributed by the demand pull factors or due to the cost push factors or due to the inflationary expectations, and how different global as well as domestic events have contributed to this price trend. And finally, students will also understand how different monetary policy measures of RBI has been instrumental in achieving an efficient money market functioning as well as achieving the price stability of the economy. Now, before going into the detail of the concept of money market, at first we should understand the basic concept of some financial system. In every economic society, you must understand that there are two fundamental economic entities. One is called the surplus spending units and the second one is called the deficit spending units. Now, surplus spending units are those units for whom their income is more than their consumption and planned investment expenditure. As a result, these units actually, they earn some savings in the form of liquid cash or in terms of some financial holdings. This savings is actually the source of supply of loanable funds in the financial market. And obviously, these units, they try to lend these savings into the market to earn some rate of interest. The deficit spending units, on the other hand, their income is less than their consumption expenditure and planned investment. As a result, these units experience some negative savings, and these units, they meet their financial needs either by borrowing from the market or they run down their previous stock of financial holdings. Now, actually what happens, this act of borrowing, that creates the demand for loanable funds in the financial system. And the interest rate that they bear for this is actually called the cost of borrowing money. Now, in between these surplus spending units and deficit spending units, there are some financial intermediaries, particularly the commercial banks and some financial institutes that bridge the gap between demand for and supply of loanable funds in the financial system. And RBI plays the role of a controller or moderator in the entire system. Now, money market is the essential component of this financial market that meets the needs of the short-term flow of credit and financial assets that are close substitutes to money. Here, by the short term, we try to mention the period of time less than 1 year, and by close substitutes of money, we want to mention those financial assets which can be readily transformed into money without the loss of their value and minimal transaction costs. Now, if we come to the functions of the money market, then we can understand that money market actually performs three important functions. The first one is that money market actually bridges the gap between demand for and supply of loanable funds in the loan market. Secondly, it allows the borrowers to obtain credit quickly and as a reasonable rate, and that meets their working capital needs, that smooths out their production. And thirdly, it acts as a focal point for the RBI's intervention in the market in terms of appropriate policy instruments that can control the liquidity flow in the economy. Now, if we go through the structure of money market in India, then we can understand that this money market is composed of two important segments. One is the organized segment and the second one is the unorganized segment. Obviously, the organized segment functions according to some specific rules and regulations in the market, and that is controlled by RBI. Obviously, in case of this unorganized segment, no such rules and regulations are being followed. So quite obviously, the major participants in the organized markets are RBI, different types of commercial banks, the State Bank of India is the largest among them, then cooperative banks, regional rural banks, then the Discount and Finance House of India Limited, the Mutual Fund, Security Trading Corporation of India Limited, non-bank financial companies, then different types of investment institutions, corporate bodies, primary dealers, etc. In case of the unorganized market, there are the major participants are the indigenous banks, the money lenders, the unregistered non-bank financial companies, and cheat funds. Now, if we go through the major instruments of the money market in India, then we can identify 6 different instruments. The first one is the call money, then there are some treasury bills, there are some certificate of deposits, there are commercial bills, commercial papers, and repurchase agreements, sometimes called repos. Now, at first, we try to understand what is the concept of call money. Now, this call or notice money facilitates transaction involving extremely short funds whose maturity actually ranging from 1 day to 14 days. If the transaction occurs for only 1 day, then it is called the call money, or it is sometimes called the overnight money. If the transaction involves borrowing and lending of the period of time from 2 days to up to 14 days, then it will be called notice money. And if it is from 15 days to up to 1 year, then it will be called term money. Now, one of the important features of this call market is that these call loans are highly liquid. They can be easily converted into cash on demand, and obviously no collateral is required to get the loan for these particular types of market. And obviously sometimes some discounting houses, they also intervene into the market to repay the loans. Now, quite frequently the commercial banks, they need these types of call loans. You all know that RBI have some stipulated norms that all the commercial banks have to keep a certain portion of their deposit in reserve. Sometimes we call it the cash reserve ratio. So in the time of credit crunch, in the time of the fund crunch rather, for the commercial banks, they borrow money from the surplus fund banks and in the call market. And the loan, in this call loan, the rate of interest that has been charged is called the call rate. Now, this call rate actually depends upon the demand and supply conditions in the call money market. During the high demand situations, the call rate tends to be high. Now, up to 1970s, what we see that most of the call market transactions were the interbank transactions. From 1971, UTI, LICs were being given the permission to enter into the call market, not only to utilize their funds efficiently, but also to increase the flow of credit into the secondary market. Now, during 1990s, some other players also entered into the market like DHFI, STCI, there is some IDBI, money market mutual funds, corporate bodies, etc. And during 1990s, RBI also given permission to those financial institutions who have sufficient funds to give loan and they are not hypothecated to any other banks, they can participate in the call money market. But this call money market have some important limitations. The first limitation is that this call money market has not been developed evenly throughout the nation. It has been mostly centered around some commercial and industrial hubs of the nation. For example, in case of Delhi, in Mumbai, Kolkata, Chennai, in Hyderabad, in Bangalore, these are actually the hubs are actually being located in these locations. And most of the cases, there is lack of coordination between these different locations. There are lack of participants in the call money market. That creates a sort of a dearth of transactional funds. And finally, the call rates are highly volatile. The second type of money market instruments are the treasury bills. Now, these types of treasury bills are actually being issued by RBI on behalf of the government, particularly when the government encounters some liquidity crisis due to the fiscal deficit. Now, these primary short-term borrowing instruments have a tenure period of up to 364 days and with a zero coupon interest. Now, these are issued by the government as the promissory notes, and these are actually a sort of term deposits. But there is an important difference between these term deposits and this certificate of deposit is that these certificate of deposits are being issued on it is a bearer form. As a result, what happens, this certificate of deposits can be tradable, can be marketable. That is not possible in case of the term deposits. And these certificates are actually issued by giving a discount at the time of purchase on the face value. such that when the person who have purchased the treasury bill is going to redeem the bill, they are going to get some capital gains. Now, these treasury bills are highly liquid due to having a well-developed secondary market for these particular bills. And obviously, this particular instrument is highly secured because government is giving the guarantee. But since this bill is secured, that's why the rate of interest is a bit low. The minimum amount of investment for this type of investment is about rupees 25,000 and in a multiple of that amount. And the purchase value of these treasury bills are being determined on the basis of the bidding process or auctions. Now, these treasury bills can be regular or it can be ad hoc. Now, in India right now, three types of treasury bills are being implemented: 91-day treasury bills, 182 days treasury bills, and 364 days treasury bills. And all the bills, in case of all the bills, the purchase price is determined by the auction method. Now, treasury bills are the second types of money market instruments that are issued by RBI, particularly at the time when the government suffers from the liquidity constraints and suffering from fiscal deficits. Now, these are actually the primary short-term borrowing instruments of the maximum tenure of 364 days and with a zero coupon rates. Now, as these are issued as the promissory notes with a guaranteed repayment date in some future dates. Okay, so whenever a person is going to purchase these treasury bills, they actually get a sort of discount on the purchase value, on the face value of these particular bills. So when they are going to redeem the bill, they are going to get some capital gains. Now, treasury bills are highly liquid because of the existence of the secondary market. These bills are highly secured because government is giving the guarantee to repay the money. And since government is giving the guarantee, obviously in most occasions the rate of return is relatively low. Now, the purchase price of these treasury bills are being determined nowadays in terms of the bidding process called auctions, and the minimum amount of investment for this bill is rupees 25,000 and in multiple of that. Now, these treasury bills can be of two types. It can be ordinary or ad hoc in nature. Right now in India, three types of treasury bills are in circulation. Both are being implemented in terms of the auction process: the 91-day treasury bills, the 182 days treasury bills, and 364 days treasury bills. The next important instrument in the money market is the certificate of deposits. Now, these are being issued by the commercial banks, excepting the regional rural banks and land development banks and some financial institutions, particularly at the time when these institutions are suffering from credit crunch. It particularly occurs at the period of time when the credit demand in the market is very high, but the deposit collection for the commercial banks are relatively sluggish. So in that situation, these commercial banks issues this type of certificate of deposits. Now, these certificates of deposits are like a sort of time deposits, but there is an important difference between the two, because the certificate of deposits are issued in the bearer form. That's why it can be transferable and tradable, which is not possible in case of time deposits. Now, these certificates of deposits have been issued by the banks. When they are issued by the banks, their maturity period lies between 7 days to 1 year. And for some specific financial institutions, that can be from 1 year to 3 years. And the minimum amount of investment is 1 lakh, and that can be increased by multiple of that amount. Now, this particular certificate of deposits market is not developed to the extent desired, and there are certain reasons behind it. The first one is the lack of proper secondary market. The second one is the very high level of minimum amount of investable funds, the high stamp duty, and there are also problems regarding the fact that whenever the commercial banks are raising funds in terms of issuing these certificates of deposits, they cannot loan this amount to any other investors. So that is the problem. And obviously, these commercial banks cannot repurchase those certificates prematurely. So these are some important limitations of this market. The next important market is the commercial bills market. Now, whenever the transaction is being made in the goods market, we all know that when a seller is selling some commodities on credit to a buyer, Then the seller, who is actually the drawer, draws a bill on the buyer, who is the drawee, that the buyer should pay the amount at some later date. Now, when this buyer accepts this and endorses it, he accepts the fact that he's going to pay the amount at some later date. Now, when these trade bills are being accepted by the commercial banks, it is called the commercial bills. Commercial banks actually take a margin of its own and then discounts the residual amount, and that meets the immediate working capital needs of the firms. Now, these types of commercial bills are also having a very limited market due to unorganized sector. Most of the cases, the transactions are not made in terms of bills, they are made in terms of cash. There is a huge stamp duty, lack of efficient secondary market, and there are some administrative difficulties as well, paucity of the de-discounting institutions in the market. And RBI has created DHFI and STCI to develop the secondary market to grow these commercial bill markets in the economy. The next one is the commercial papers. These types of papers are actually also some sorts of borrowing instruments, particularly issued by some high-rated corporate bodies. When they need funds and they raise their funds directly from the market by issuing these types of commercial papers, and the minimum amount of investment is about 5 lakhs, and these types of commercial papers are issued within the maturity period from 7 days to 1 year. The last one is the repurchase agreements. These are actually the repos and reverse repo instruments that has been utilized by RBI. Sometimes we call the liquidity adjustment facility that the RBI can get out of these types of policies. Now, sometimes what happens that commercial banks, in dearth of their funds, they borrow from the central bank, RBI, against the collateral security of some government security, with the condition that they will repurchase the securities at some later date with certain price. Now, the rate of interest that RBI charges on the commercial banks is called the repo rate. Now, it can be easily understood that if the repo rate goes low, then that will actually reduces the cost of borrowing funds from RBI by the commercial banks, and that will increase the supply of liquidity in the market. During the times of inflation, RBI raises the repo rate. Now let's try to understand some of the reform measures that has been initiated in the Indian money market till mid-1980s. Now, up to mid-1980s, Indian money market was relatively underdeveloped compared to the developed markets in the world that was characterized by low depth, lack of instruments, and highly administered rate of interest. Now, from 1980s onwards, there was a series of measures have been adopted by the RBI and government to increase the efficiency and functioning of the money market. And in this respect, the first committee under the chairmanship of Shubham Chakraborty was appointed in 1982, and the major objective of that particular committee was to look at the entire structure of the monetary system and how to effectively use the monetary policy to realize the goals of the basic planning objectives in the nation. Now, the second committee that was being appointed with the chairmanship of N. Vagul, who have submitted its report in 1987, who has also recommended several steps not only to broaden but also to deepen Indian money market. And in 1991, RBI has also appointed another committee that was under the chairmanship of N. Narasimham, whose actually the basic purpose was to restructure the Indian financial system, its functions, its procedures, etc. Now, government has introduced most of the recommendations that has been given by all of these committees, and these are called the reform measures in Indian money market. Now, in your study material, there is a detailed explanations about the reform measures that have been initiated till mid-1980s, but here I can mention a few of them which are more important compared to others. The first one is actually the development of DFHI and STCI, which to facilitate the secondary market functioning. The second one is the introduction of some new money market instruments in terms of 182-day treasury bills, 364-day treasury bills, then certificate of deposits, commercial papers since 1989-90. Then there was a gradual shift from the administered interest rate system to a market-based interest rate system to realize a better price discovery. Then, in case of the liquidity adjustment facility, the repo rate was introduced in 1992 and the reverse repo rate was introduced in 1996. Then there was also the discontinuation of the ad hoc treasury bills and 91-day on tap treasury bills, and that was being substituted by ways and means advances linked to the bank rate. There was also some establishment of Clearing Corporation of India Limited in 2001 to clear all transactions in government securities and repos reported on negotiated dealing system. There was the introduction of the primary dealer system in 1995 and satellite dealer system in 1999. Then the money market mutual funds have been introduced in 1992, and RBI enabled private participation in money market mutual fund sector. For which there have been money market instruments, mutual fund instruments have been implemented by UTI and IDBI. There was also the regulations in case of the functioning of the non-bank financial corporations. Without the permission of RBI, they cannot enter and function in the money market in that sense. There was also the development of special recovery tribunals in 1993 by RBI that will assist the commercial banks to recover their past debt. And finally, a system of electronic transactions that will not only ensure transparency, but will also ensure efficiency and flexibility in the money market. Now, at last, we are going to discuss about the shortcomings of Indian money market. The first important shortcomings is the existence of a huge unorganized sector that is beyond the control of RBI. Now, in unorganized sector, the rate of interest is relatively higher than the organized sector. So this multiplicity of the interest rate in the money market that impedes its proper functioning. Then obviously, there is a lack of coordination and integration between this organized sector and unorganized sector in the money market. There are paucity of the money market instruments, and that is also creating problems in its comprehensive growth. There are not enough primary dealers in the India's money market. There are lack of financial literacy and awareness, what I think is another important problem in case of the money market growth. Most of the cases due to this problem, the rural sector particularly, the people who are saving, that is not coming directly to the organized sector. And in most of the cases, due to lack of awareness and this literacy, most of the investment decisions that they are making are very much unwise, and they are end up with a sort of debt. The high stamp duty in the money market, that also limits the transactions involving stamp duties. The call money market we have already mentioned in our previous discussion that is not being developed uniformly throughout the nation. There are a problem of coordination and high fluctuation of the call rate. The call rates are highly volatile. The commercial bill market is also not developed. There are certain reasons I have already discussed in this connection. There is a lack of secondary market. That is another important problem in Indian money market. And the lopsided development of Indian banking system, despite the considerable efforts of the governments to increase the flow of institutional credit in the rural sector. But if you see the branch inspection of the commercial banks, then it will have a typically urban bias. And finally, corruption and fraud, that is a problem that also exists in money market, and that actually undermines the faith and confidence of the investors in participation in the money market. Now let's try to understand the concept of inflation and the price trends and inflation in Indian economy since the inception of economic planning in India. Now, the concept of inflation, if we try to understand that if we want to define inflation, then inflation can be defined as the rate of change of general price level. Now, this general price level is calculated on the basis of the weighted average of the prices of different goods and services in an economy. Now, these weights are actually showing the relative importance of those different goods and services. Now, in India, there are three major indices by which we try to capture this general price level. The one is the wholesale price index, WPI, then the consumer price index, CPI, and the GDP deflator. Now, wholesale price index is actually, we are considering a basket of wholesale goods, the tradable goods, including all categories and subcategories of those goods. And we try to formulate the indices on the basis of the relative weights of those goods and services. In case of consumer price index, we actually try to capture the cost of living of a homogeneous group of consumers. The commodity basket obviously comprises of those commodities that those homogeneous group of people consumes. And the GDP deflator is actually the ratio of nominal GDP to real GDP in a particular period of time. Now, this CPI can be again of four types: the CPI of industrial workers, CPI of agricultural laborers, CPI of rural laborers, and CPI of urban non-manual workers. But in most of the academic and policy debate discussions, the most preferred index for measuring the general price level has been taken as WPI. Firstly, maybe because of the fact that is the wide coverage of commodities into its ambit, and the second one is that the high frequency level data is available for its calculation. But obviously, WPI data has a sort of limitations because it does not include non-tradables and services in its scope. Now, if we look at the price trends and inflation in India since the inception of planning, then it will be better if we go through different decades. Then we will understand how this inflationary problem has been developed, what are the possible causes, and what RBI has taken steps. Now, if we look at the 2005 to 2020-21 period, then the average inflation rate was about 4.35%. But one interesting point in this connection to note is that the food price-led inflation was a bit higher than the general inflation rate in this particular period of time. In 2018-19, at the end of 19, the corona pandemic set in, and obviously at that time in 1920 and 2021, the fiscal years, government have to go through different types of expansionary fiscal policy to revive the economy from the recession. RBI has also gone for expansionary monetary policies to increase the flow of credit in the market. And all of these effectively increases the money supply in the economy. And obviously that has also increased the fiscal deficit of the government. But at that particular point of time, the major focus was not to target inflation. The major focus was to revive the economy from the recession. So basically during this particular period of time, if you look at the trend of inflation, one interesting observation you can also follow during 2007-8 to 2012-13, immediately after the American financial crisis, you will see the inflation rate was a bit high, close to 8.2% on average, but later on it declined. And again, during this corona period, one of the exceptional times in the history of Indian economy as well, so we have experienced a little bit of inflation. The inflationary target which was being set by RBI, that was not being met subsequently. It was about 7.89% WPI inflation rate during the March 2021. Then followed from that time, 13 consecutive months, we have got the WPI rate into the double digits. And if you look at the month of May 2022, then this WPI rate went up to 15.88%. That is terribly high. And that was due to some sort of problems regarding the supply side logistics. The global supply chain was being disturbed by the war between Russia and Ukraine. And particularly, there is an increase in prices of the crude oil, petroleum, natural gases. There are some basic metals and food items that cause this size of crisis. The food price inflation right now stood at about 12.34%. And due to the geopolitical tensions, Indonesia has also imposed a ban on export of on the palm oil. That actually has increased the edible price. The prices of the edible oils in the skyrocketed, and we are expecting that for the coming few months, the price will stay high as well. Now, to check these inflationary pressures, RBI has to raise the repo rate by 50 basis point in June 2022, and now it is raised to 4.9% to curb the inflationary rate. To conclude, you can say that the monetary policy framework in India has undergone significant changes over past few decades due to different types of developments in the financial markets, and India is getting much more complex and globally integrated economy. And obviously, the monetary policy instruments that has also been changed. The monetary policy targets that has also been changed over time.